Hello and welcome to another District Capitalized webinar from the DC Department of Small and Local Business Development. Today we're having us talk about our crowd building for capital pilot, specifically the third in a four-part series of webinars to help educate businesses about financing options, including equity crowdfunded investments. Today we're doing a deep dive on business investment one-on-one, both equity and debt, with our pilot partners 20 Degrees and the Marigold Effect. I'll pause here for anyone on the phone, on the webinar, or on demand. This and all of our DC government services and information can be translated into another language of your preference. Just let us know, we'd be glad to do so. A little bit of how we got to this project and this topic today. Here's a quick chart showing how often businesses fund their operations. Most of it is bootstrapping using personal finances or money that they have from another job that they're employed at. Going to traditional loans are an option. About 11% go for bank loans. 17% ask others. Their intimate crowd of friends and family, about 17%, 11% for the bank loans, but not as many pursue crowdfunding, less than 2%, and investment, less than 4%. But when we're looking at those numbers, even fewer within that small amount, even fewer of them are women-led or BIPOC, Black Latinx businesses who are pursuing crowdfunded investments. And we were wondering why. And part of it is that I don't know if we don't think people have a clear understanding of the options out there and what it means and how it could benefit them and when to use it. So we began exploring that topic to make this an option available to more businesses in the district. We joined with 20 Degrees, which is a DC-based business, a CBE, the DC Women's Business Center, and received support from the National League of Cities, City Innovative Entrepreneurship Program to have this pilot, Crowdbuilding for Capital. Through that, we're hoping to connect businesses with resources and information so they can begin to explore what these options are through equity crowdfunded investment and also pursue it. So as part of that, we have several educational opportunities through these webinars. Again, this is the third of four-part series. Also, if you go to the main registration page, you'll get links to the first two webinars if you'd like to watch or rewatch them. We have guides, a self-assessment tool created by 20 Degrees to help you assess your readiness to pursue capital. And then we have free coaching available to eligible businesses. All of our webinars are open to anyone who'd like to attend, but the coaching is only available to DC-based businesses with a priority for women and BIPOC owners. And BIPOC is Black, Indigenous, people of color. So here's where we're at right now. We're having today's webinar on the 21st. Our last one is next Monday. We hope you'll join us at 3 o'clock for crowdfunded investment with BeFunder. So we're pulling in all the pieces of, we talked about crowdfunding in general this past Monday. Today we're talking about investment. And next week we're pulling together crowdfunded equity investment. And we'll have BeFunder join 20 Degrees for the presentation, as well as a founder who's going through a raise right now with 20 Degrees, a DC-based business, to share his experience about using this financing option. And also next Monday, we're opening up our applications. So again, the coaching is just free to qualified DC-based businesses, but you do need to apply. It's a paperwork-free application. We'll ask questions about you as an owner, your business, and then your financing needs and any prior experience. So to apply, we'll send out the link. And you'll have a week to apply. We'll talk more about that at the end. And attending webinars is part of that application process. A little bit about DSLBD and myself. Again, DSLBD is the DC Department of Small and Local Business Development. We're a DC government agency that'd like to support DC-based businesses and DC residents exploring entrepreneurship at all stages across all topics. Our team in DSLBD, the Innovation and Equitable Development Team, or Inno.ed, we help businesses at all stages, and we have lots of different programs around certain industries to help you build your capacity to open and operate your business in the district. And one of those programs is what you're here today for, the District Capitalized Program, which helps coordinate our efforts to help businesses finance their operations and growth through revenue and through capital, and also how to manage that money when you do earn that. Another resource that's through our department that may be of interest is the dcbusinesstoolkit.com. It's a great place to find all the information out there about classes, events, guidance, regulations, other ways to also connect with each other virtually. There are over 150 providers in the district, including agencies and nonprofits there to help you. We have a Kiva crowdfunding, which is a loan-based crowdfunding. We just had a session on Monday. Here's the link to get more information. Lots of trainings. A lot of our trainings are put online at YouTube sites. You can watch them on demand. And you can also connect with us in person. Today I'm at the MLK Library on G Street. We're here every Wednesday. Or email us to set up an appointment. We'd love to connect with you and help your DC-based business. And that's just for reference, a little more information about District Capitalized. I do encourage you to sign up for our DC Business Funding Alert. That's a great way to have information pushed to you about funding opportunities and classes to help build your capacity to manage the money that you do receive. I'd like to bring in our partners, 20 Degrees, and the Marigold Effect will be presenting today. Have them tell a little bit about themselves, and then we'll kick off into our content today.
Everyone, we are so happy to be with you today. And I will say this is one of my favorite topics, especially to be alongside Pooja, the founder of the Marigold Effect, because this is the type of information that often feels like not everyone gets it. So we have a shared ethos between 20 Degrees, which is the ideal angle to skip a rock on water. Our firm works to make sure that organizations, especially those led by women, Black and Brown founders, have access to resources. And what we're talking about today is the straight talk, the stuff that you could read a whole lot, you could learn out there, but we're just distilling it down. And from one of my favorite collaborators, that'd be Pooja. So Paula is also with us. So why don't we briefly kick to Paula to say hello, since she's doing a lot of the background stuff. Then Pooja, will you take us into Business Investment 101?
Yeah, sounds great. Sorry, I realized that I was muted. Hi, everyone. My name is Paola. Very happy to be here with y'all. I'm doing a bit of the management on the back end, so here we go. But just very excited to be here. As I like to say, I'm crowdfunding and financing curious, so very excited to be learning from Pooja and Sarah, and just very excited to be here with y'all. So kicking it to Pooja.
Awesome. Thanks, everyone. So happy to be here and collaborating again with 20 Degrees. I'm with the Marigold Effect, and the marigold is actually a companion flower. And when you plant it nearby certain vegetables and plants, it helps them flourish. And that's my hope, to be part of this ecosystem. So wonderful. We can go ahead and advance. So yeah, so I think we will get some of the answers from the poll here. I know that Paula's having to go back and forth with it. Thank you so much for that. Certainly people can feel free to come off of chat and we can make this super interactive. But we really want to get people starting to think about what do we mean when we say an investment? So buying stock in Zoom, right? So that could be a business can actually invest in the stock market, but certainly us as individuals for kind of building our own wealth may think about that. Anybody else have any other ideas? I know for a lot of Americans, home ownership is one of the biggest investments we make and one of the biggest ways people do attempt to save. I don't know if Sarah and Paula have any thoughts about any business or personal investments.
I think if you have responded to a GoFundMe or Kiva, that would be we all give money in our community in different ways, shapes, or form. That's one of the great things about our community. And I think what we're looking for here too is we're really actually all investors are not mysterious people out there in the world. They're people like us. And that's what we actually make some of the best investments out there is when we are investing in and alongside our community. So we're going to be talking a bit today about, what investors are looking for, but you know what the mindset is because you know what a good option is and what a good deal is and what a good opportunity looks and feels like. So we're going to put some more details around that, but we're inviting you in to sit in shoes that you might not think you belong in, but you do.
Yeah, I'm seeing some great ones coming. Yeah, definitely. A loan is, we're going to talk about just exactly what type of investment that is. Buying another business for sure. And yeah, and I think that one of the things we think about when investments is things that will have a long-term value. Sweat equity, also known as earned equity, can definitely be a way to use your time and your talents in a business that may reward you with some type of ownership path. Very cool. Awesome. Thank you, guys. So I'll give you a little bit, actually, Paula, you'll continue this.
Oh, cool. So this is just a roadmap of where we're headed. Oh, this slide is also not up to date, so please excuse me. But we are here, September 21st. We're talking about equity and debt, business investments 101. We, as Camille mentioned earlier in the webinar, we will be opening up an application for select slots regarding coaching. So definitely keep an eye on your email for that. And on Monday, we'll be talking through just crowdfunded investments with WeFunder. So if you're curious about WeFunder, if you have some burning questions, definitely be sure to attend, or, if you're just crowdfunding curious like me. So
I will say there's a bit of a process here, and that's intentional. We always say we want to be straight with our community. All of these types of money are not easy money to get, as I know some of you here can attest to. So what we're doing is offering what it really takes, and the multiple webinars have information that we don't believe you're getting a lot of other places. So that way if you decide to pursue investment, you have your eyes wide open and you won't be surprised at, one, how hard it is, and two, the things that you need to show up to get to the starting line with. And I think you see a little bit of who we are. At the end of the day, we are change makers, and revenue and capital and new forms of money is our preferred way of making change. I feel like is that an okay we statement there, Pooja and Paula?
Absolutely.
Excellent. So you can look us up, and we're doing this because we love the district and believe in all of you as founders and entrepreneurs.
This is just a high level overview of what we're going to do with our time here together. Kind of just come to a shared understanding of what investments are, the two major types, debt and equity, a little bit about the hybrid options that maybe you'll only see more in the startup space, and then really help you think through some of the next questions about what type of funding might be right for your organization. So yeah, the question, what is a business investment? So it's something that you acquire with the goal of it generating income or increasing value in the future. I think there's a lot of ways to think about investments in a non-financial status, and those are all truly important. But here, when we're kind of level setting, it's about that. So Patreon, where maybe you are a creator and you have people support you that way. It's not necessarily that a supporter is investing in your business. They may just be paying you kind of almost like something that would show up as revenue. And that's something we talked about in check out webinar 1 if you want to understand a little bit more about revenue versus capital. Kickstarter, that's a lot of times where you're actually exchanging in terms of some kind of a reward. Indiegogo, also kind of a little bit similar. And then GoFundMe would be more like in the donation space. So really the distinction here with the investment is really that when you put yourself in the investor's shoe, they're really giving you money because they think that money you're going to take and you're going to grow it with like your skill set, or that there's going to be some type of like income that they'll get from it. Like, when you put money like in maybe a certificate of deposit, you expect that there'll be some interest. So we talked a lot in webinar 1 about why you would need an investment. And we're trying to kind of get people to think about the vision that you have for your business long term, and trying to find the investments that would help support that. And also, a lot of our goals with this 4-part series is to help you guys to strengthen your business for really what investors look for. And a lot of times investors really are interested in funding these long-term needs. There isn't as many people that are out there want to be like, oh, I'll help you pay like September's rent. But people may be like, oh, I want to help you buy that building. And so when we think about investments, we try to think about how do we get people excited about that long-term bigger vision. for actually like financing your business. I always think about it as in two major types, like the internal investments that you have that really come from you, and then the external that come from outside investors. One way that a lot of businesses is often called like bootstrapping or whatnot, but it's when you're kind of like taking your personal savings or you're taking your company's profits, and you may never actually be taking money out of it. We always tell businesses you want to pay yourself. So that's definitely that. But maybe you give yourself a salary for your business, when it is feasible. Obviously in the beginning it may not be, but then you think about, okay, I had some extra profits. What do I want to do with them? If I want to grow my business, I can use my own money. But maybe like that's not enough money, or you're like, wait a second, let me see what I can do with other people's money. Then we look to external capital. And today we're going to be really focusing on two major sources of external capital: debt and equity. Debt. So that's when a company is going to borrow money from an investor, but there's an explicit actually promise to pay it back, and then generally with interest. So we would say the amount of money, let's say I'm going to borrow $1,000 from a bank, and they say, it's 5% interest and it's for a 3-year loan. That would be a form of debt in a loan, where it's like, I'm promising to pay this bank back a very specific amount with interest over a certain time. It's a huge contrast to equity, where it's actually saying, okay, this is not actually 100% my business alone now. You've given me some money, and I'm going to give you a little bit piece of ownership. So it's not just Pooja's, palace. It's also going to be now maybe like Sarah's got a little piece of it, Paula's got a little piece of it. And we're going to talk a little bit about like, why would you even be open to sharing anything with Sarah and Paula? They're great though. Okay, so debt financing. So again, that's when the company is borrowing money from an investor. And feel free, everyone, like drop questions in the chat, come off chat. If you feel like anything is, I know these topics are quite dense, and especially if this is something you're hearing for the first few times, it's a little bit challenging. So we'll start with like kind of the types of debt that you could be like, it could be secured, which is backed by your assets. It could be a business, it could actually be your personal assets as well, or unsecured. So if I am a company and I want to borrow money from a bank, they might be like, okay, great, I'll borrow you money for your coffee shop, but I want you to put your personal home as a guarantee, or you sign as a personal guarantee. That's obviously more responsibility on me. But I might find a lender that's like, okay, this is an unsecured loan, here's the money, and then they don't have any kind of claim on other parts of what I own. So again, it's an obligation. That's a big part of debt. It is a promise to pay this back. And oftentimes there's like some kind of a set regular schedule. We always think about maybe like monthly, but that doesn't mean it. Sometimes you can, when we talk about the crowdfunding piece and building your offering, you could pay back something quarterly, pay it back monthly. There's even some scenarios where people pay it back yearly. But basically you at the beginning would have some kind of a schedule about when your maturity date is. And then basically, regardless of how your business is performing, most often than not, you still have to pay. So if you think about, the easiest one being like, I have a mortgage, and every month I have to have a payment. I'm paying some principal back and some interest. The bank has my house secured against it. So if I stop paying, they have a right to take it back. If I get laid off, my husband get laid off, anybody, they're not going to be like, oh, Pooja, like, let's cut you a little break here. Upside of that is that I get to maintain all the ownership of it. I don't have to give any rights to anybody about how to do my business. Once the loan is repaid, my obligations and relationship with whoever's borrowing me the money is over. So it's not like this long-term relationship we're getting in. I mean, it could be if it's like a 10-year loan, but once I'm done with my obligation, we're good to go. I don't know if anybody's ever had a balance sheet on their business or in their life, and when you're like, oh my gosh, I have so much debt, who's ever going to give me any more money? That's something for anybody to consider with debt. If I'm looking to lend somebody money in my role as an investor, and I look at their balance sheet and they already owe like everybody in the neighborhood, like a ton of money, I'm going to be like, I don't know if I want to loan to you because there's going to be a lot of people in line to collect money if your business ever went under. So you always want to think about that. Like once you start to accrue debt on your books, it makes it a little bit harder to get that next thing because companies don't want, or investors may not want to see a business that's like super, what they say, like debt leveraged. Nice thing about debt though is interest payments are deductible. So like on your tax, on your income statement, you can deduct it so you won't have to pay taxes on the portion that went to service the debt or the interest. And then just in terms of ways that you can like think about, I was like to say, get in the investor mindset. An investor might be like more interested in being a lender to you rather than equity investor because they know that just the way that bankruptcy laws and all these work is that a person who borrows you debt gets paid back before a person who owns a piece of your company. And then also a person who has like secured debt would get paid back even before that. So in terms of like secured debt, you got to pay those people back right away, then unsecured debt, and then your equity investors in terms of if you ever sell your business or it gets liquidated.
Also, your personal credit score and your personal financial position, even if you have an LLC or some other situation, is absolutely what lenders will look at. If your credit score is not where you want it to be, we'd recommend starting something small. Life Assets is they have a great program for beginning to establish a business credit and a presence if you need that. And then what we see is across the community development finance institutions, so groups like WakeIF or City First, that they each have different lending that they like to do in both size, amount, and types. But if you pursue debt, be prepared to have your own finance looked at very, very closely, which is not great, especially because credit scores can be unfair and they are not applied equally. So this is a disadvantage to companies and owners who don't live near a bank, which has nothing to do with our history of paying back loans. But that is some of the invisible things behind credit scores. But there's a lot of great partners here in DC who know how to work through that.
We're going to cover like 3 different types of debt that you may see. One would be like the standard term loan, your fixed interest rate when you begin, or even could be a variable interest, and then you have your repayment schedule set out at the beginning. So 5% paid to interest, investors monthly, let's say for 3 years. There are zero interest loans. So the Kiva program in DC is a great example of that, where especially if you're earlier on your business, and it could be a way to make that, opportunity to build up your credit history as a business and demonstrate to future investors your ability to pay without having that additional burden of debt. Revenue-based loans. So this is something that's slightly confusing to like wrap your head around sometimes, but if you think about it, it's not a fixed payment. Oftentimes they're designed where it's like you pay say 5% of your company's sales until the investor makes up a certain dollar amount. So maybe you borrow $1,000 from an investor and they're like, I want to get paid back $1,300, and every month you would be paying back 5% of your sales until the investor got the $1,300. The way that that's good for a business is that in months in which like your business really suffers, your payment could go down a little bit because you're always only having to pay 5% of your sales. Whereas a fixed payment in a bad month, you're more, the fixed thing could represent like 20% of your sales, So it's a way to kind of protect yourself that way. And then investors like it because the better your business does, the faster they get repaid. And so everybody likes to get repaid back faster because that means that they can even reinvest their money sooner. So it is a way that I see a lot of, especially like impact-oriented investors trying to move towards. So like anything, it's never all good or all bad. If you think about it in terms of some of the pros, you do get to retain full ownership of your business. And so That's always nice. Doesn't mean you're not without a boss, right? Because a bank or anything might still check on you to see how you're doing. It's a time limited relationship. Again, like you don't have to have this investor in your hair for the rest of your life. You know, sometimes you even may try to figure out a way that there's no prepayment penalty, meaning like if your business starts doing really good, you can even pay them back faster. Or if you ever get a, you know, your credit score improves and your business history improves and you could refinance. So it's a way that you don't lock in your relationship forever. Again, interest tax deductible, predictability. I think a lot of times businesses really benefit from not, you know, being able to just kind of forecast your projections, like, okay, like what are my expenses going to be? And you know this better. And then it's just simpler to kind of wrap your head around, and like when you get to equity, you'll see what I'm talking about. The challenges of it though, I mean, I think Sarah really alluded to a lot of them. It is often you need to prove that you're not a credit risk. And so that is sometimes not easy for new companies to be able to prove because you don't have that history. But there are a lot of nonprofit lenders and a lot of programs to think about how you can do that. There could be a risk if the investor says, okay, we'll lend to you, but we need some collateral. If you aren't able to pay back the principal and interest to investor, they could force you to liquidate your assets, meaning sell some of your business in order to pay back. So that's always a risk to be thinking about. Again, like if you have too much debt on your balance sheet and then later you want to go and get some more debt, it may make it harder if you already have some. You definitely need to make sure that you have the revenue or some type of money coming in and able to support those payments. So if you absolutely don't have sales, I mean, you might not even get this type of loan, but even then, like, how would you actually repay it? So you want to always be thinking about that at the beginning. And then we just live in this kind of, you know, crazy climate right now, and I don't know what interest rates will be like tomorrow. So it is the uncertainty of this environment is something to think about. So, you know, before you even think about debt, you want to ask yourself, you know, would you even qualify? So that's just, you know, it's good to figure out, is this something that you're even eligible for? And we'll talk a little bit about getting started. Could you expect a positive return on this? Maybe it makes sense to borrow like $10,000 at 5% because you know that you'll take that $10,000 and like buy a bunch of machinery that will help you increase your sales so that your sales will go up like 20%. Well, then, you know, debt could be a really great thing for you. Obviously, I mean, you guys are all business owners, so you know about risk already, but debt is something that you have to be comfortable with some level of that. And then, you know, if you want to maximize your money, and kind of what I mean by that is that getting some like kind of long-term benefits without having to sell some part of your business. Because if you have a business that's worth like just, you know, your ideas today, debt, and you just get debt financing when it's done, it's still your business. But if you have a business that's like, maybe one day it's going to be, you know, a bigger deal than Airbnb and Google put together, you borrowing, you know, $10,000 is a better thing than selling some portion of your business for $10,000 and then for the rest of your life having to share a portion of your equity. So how to get started? I mean, I think that one of the things that, you know, we always talk about is, and we talked about it in the first webinar, is make sure that you understand what you need the money for and the dollar amount. You know, especially with debt, you know, actually any kind of investment, you really don't want to take more money than you need because no money is free money. Checking your eligibility, it's a good time to get your kind of financial house in order, make sure you understand your credit score. And even if there are things in it that may seem that give an investor pause, like, can you explain it? You know, is this like, was it something like, you know, very out of the normal, or is it something that you just have this consistent history? And what can you do to start to improve that? It's good to like compare all the options. There are so many lenders out there now. So you want to make sure you, you know, also try to explore like the ones that are the best for you. Community lending, nonprofit lenders oftentimes have where they won't necessarily have as high rates or as high of a hurdle to make. And that could be good to get some money there. Traditional banks, all of that. documentation, debt, they will want to review your tax returns and everything like that. Thinking about what is the amount that you can actually repay. Again, like going back to like your finances, and this is one of the things that anybody that, applies for the application with the coaching, we really want to talk about thinking about what should your offering look like that makes the best sense for your business.
We also would say make sure you talk to your current banker. And if you haven't talked to your banker, do that before you apply. Bankers like to talk to their people. They are oftentimes they like to give loans because it's how the bank makes money. So they want to talk to you. If you're not with a bank that gives you loans, sometimes you have to move your accounts there. That is part of the expectation. And we should also say if you get a loan and run into trouble, call your banker. They would rather work with you than have to chase you down. We've heard that from many bankers. So you really do need to form an actual relationship. They want to be in your business, which isn't always fun. But it is how this type of money works. You don't give them a piece of your business, but you do give them access to just about everything that's important related to your financial position and your bank and your businesses.
Yeah, that's great. Okay, so kind of the biggest contrast to debt in terms of an external investment you can make is equity. And that is to sell a piece of your business to somebody. And so if you think about it, once you sell a piece of your business, then that investor shares in an opinion about your business. And again, you can draft your offering to kind of determine how much of your business you want let others to have input on, but to know that there could be some statutory requirements, meaning some legal requirements about what an investor needs to know. But you will definitely have to share some ownership with it. And that could be the profits from it. It could be like when you sell the business or however you may end up ever, closing or exiting the business, but to know that's going to be part of it. Valuation. So this is a very tricky topic, especially in a newer business, is to say, well, if you give me $10,000, like how much of my business should I give you? Is that worth a 1%? Well, then fine, like, cool, give me your 10 grand. But what if my investor says, okay, for $10,000, I want 50% of your business? Then I'm like, so wait, you're trying to tell me my business is only worth 20 grand? So, you go back to numbers, you go back to figures, but valuation's a little bit of a science, a little bit of an art, and it's a supply and demand, how much people want to give you money versus what you have. But obviously, the stronger your business is, your revenues, your product market fit, the number of people that love what you do, the higher a valuation you can claim, and make that argument to an investor so that the amount of money that you take from them translates to as little of your business that you have to share.
Pooja, can you talk a little bit about how you might go about just getting an estimate of what your business is valued at, so you don't go into those conversations with investors not having an idea of what your number is?
Yeah, no, that's a great question. So, if your business is already generating revenue, and has profits, a lot of times you can look to your industry or to competitors to see what would be considered like what multiple a business gets sold on. So for example, I've sold some restaurants, and restaurants get sold on a multiple of your earnings, between like 4 and 6x. So if after, I've paid my interest expenses and everything else, I have $100,000 left. Maybe I can sell my restaurant for 5 times that to somebody, 500,000. That could be a pretty agreeable, conclusion we can come to. Something like software if you have a software business that doesn't have a whole lot of assets, you can maybe make an argument that like your revenue deserves and the quality of your sales deserves a higher multiple. Oftentimes it could be that you say, okay, like I'm about to, build a product in which like the market, like let's say I'm in I'm a dog walking app that's going to make it so that like robots can walk dogs. Well, I don't know about y'all, but the pet industry is like, out of control. So you could really maybe make an argument to investor like, oh man, people love their pets. Like it's a $1 zillion industry. Well, then you can maybe make this argument like, my business should be valued more because I know that I can go after so much of this market and make like so much money in it. So it's a lot about knowing your industry, knowing about like how big your market is that you're in, and then also just proving that you have traction and growth. So really, I always say like whatever makes your business attractive to you will make it attractive to investors. I think sometimes people think that investors are looking for some crazy things that are no, they want to make money. And most people who start businesses, in addition to all the other reasons, making a difference, it's what you love, you probably want to make money too.
We have a question in the chat of just
Oh, yes, thanks.
any leads on somewhere to go for help with agreements or contracts involving financials.
Yeah, sure. I think that there are a lot of nonprofits that do that. I know like SCORE. I think there are probably a lot of resources on the INNO website about people that provide that type of technical assistance. I know at 20 Degrees, Marigold Effect, that is something we also, care a lot about helping people get comfortable with their numbers. I know a lot of entrepreneurs, like they know like a lot about their business, but they're not as comfortable with the financial side. And your finances tell a story. And the more comfortable you are with them, the more you can make sure that you're telling investors the right story.
And if you're serious about pursuing investment, this is money you need to spend up front. That your financials sparkle and that your contracts protect you. It is not cheap. At the level you really need to pursue to get serious investment. Maybe not an initial piece or some of that, but it's a little bit of a how to get to the starting line is having strong financials that you also have familiarity with, and same thing with contracts.
Yeah, and definitely, like I think this pilot, we encourage people to apply. I think with the coaching, we'll definitely point you in the right direction for your particular unique circumstances. Now back to the other one. Just in terms of exit timelines, this is something that, with debt, you kind of know, like 3-year term, whatever. With equity financing, you have to think about, okay, if this investor gave me $10,000, they're going to want their money back at some point. And I want to think about how they are. You hear about like companies that like have initial public offerings, IPOs. A lot of times people start companies because they think that's what's going to happen. That's certainly not the trajectory for most businesses, but it could be that your exit is that you run your business and then when you retire, you sell it. Or your exit is something that I see in the impact investing space is maybe you find an investor that says, okay, I'm going to own some of your business, but you can pay me back with profits and redeem your equity, meaning every year I'll own a little bit less as the investor, you'll own a little bit more as the entrepreneur. So it's about finding how do you get, and that would be kind of like a structured exit. How you want to figure out as you start, like what's the end? Because you don't want an investor pushing on you later to say, okay, sell your business because I want my money back. You want to make sure there's some established understanding about how an investor would potentially get their money back. Again, those equity investors are paid later. So a lot of times this capital is considered like patient capital because they know that they're last in line, but they get to share in the potential upside a much more than a debt investor would. And as you can probably see from everything we just said, it's a little bit more complicated than debt. Just even the valuation question alone is a lot more. I mean, like when you loan somebody $10,000, it's $10,000. When you invest and own a company with $10,000, it opens up a lot more questions. So 2 major types of equity that you see offering is common stock and preferred stock. Common is like simple. It's usually what, you as a founder would have. And then sometimes you hear about maybe like people getting paid with equity. especially an early startup that maybe can't afford to pay too much, or thinks it's a really good way to incentivize an employee to stay with you long term because you're like, I'm gonna be the next, Google one day. So that's that. You usually get some voting rights in it. And then basically investors with common stocks, they are a little bit later in line. So preferred means that you're preferred in line of payments. You come right after debt. Outside investors often like this type of stock because you can have some more influence on the company. You can say, okay, I want to have a board seat with it, or I want to have some voting rights, meaning like I can tell the owner of the business that I've invested in how to make certain decisions. So again, these are all negotiations. If you think about, your offering, you have to figure out what you're comfortable with. And we always say you want to accept I think Sarah put in the chat, you want to find the right investor. Not everybody's money is good money. So pros and cons. So one of the biggest pros of equity is investors are not creditors. So if for some reason, you start your business and it doesn't succeed, your investors can't come after you for that capital that they gave you. It's just a risk that they take because they are going to get some of the upside. If you have equity investors, because debt has a priority for payment, people would still potentially be able, be interested in lending you money because they know that they would come in before. You don't have this pressure of monthly payments. You can decide when it is that you return capital to investors. If it's like you say, oh, well, we have, $100,000 in the bank, now's the time to make a dividend. But there's not a pressure the way that a monthly loan obligation would be. And in general, there's no interest accruing on the equity financing. If you got $10,000 as an equity investment, it doesn't have like some thing that's growing that pot of money aside from just the appreciation and value of the business. The cons, got to share that ownership with whoever gets, and depending on, if you're giving up 10% of your business or 50% of your business, it looks like how many opinions you're going to get from that investor. Your control could be limited based on that decision making. So, if you have an investor that has 50% of your business, they're going to have equal control. If you have 49%, it changes things. It's time consuming to do. And one of the reasons why the whole crowdfunding kind of came about is that it's a way because basically when you make an equity offering, especially publicly, there's a lot of legal securities laws that you have to jump through. And crowdfunding is one way to have an exemption of that, to talk to the public about it. But otherwise, you would have to file something with the Securities Exchange Commission. So it is a more costly way to raise money.
And if you think in some ways it's easier because investors and that's why actually we think there is some promise in crowdfunding as well, is you are going to have to go sell your idea. Are you going to sell it? And what percentage are you selling to customers? What percentage are you selling to investors? But just know that there is not free money, and whatever free money there was available, it's basically gone. So with very small dollar exceptions. So this is really help you determine what type of people do you want to spend time convincing of the value of your idea and how much money it will make. Where crowdfunding, it's a little bit of customer, right? And also investor work. We'll get into that later. But I think what I really appreciate, Pooja, is just naming that there's some pretty significant hoops that are very doable. It can and it is done by many people in the district. But we like to make sure we're just helping people match the right kind of money with where you're at in your business.
So when is equity the right choice for you? I mean, certainly if you want to avoid debt, it makes sense to go in that direction. It is less pressure on your business. If you're a startup and you don't have profits yet, it's much easier. Well, I would say it's much harder to get debt than if you don't have a path to repayment for a debt investor. But if you have a startup or an idea that really has the potential of gaining a lot of traction and value, it may make you really attractive for equity investment, and maybe getting that money right up front will really help you grow your idea.
Pooja, can you talk about startup versus small business? I always love
Yeah,
that.
sure.
You talk about. I love pitching questions too. Some of the ones that I've loved talking to you about.
Yeah, for sure. So I think that, I just did a talk about that at DC Startup Week. And so my main takeaway is that a startup is really focused on being high growth. So it is where you think that it is going to have almost like what they call like exponential growth. And if you think about it, like, I used to own restaurants, and every year, wanted my sales to go up, but they never went up like 20 or 40%. They went up like 2%, 2%, 3%. And so it's not really that like enticing to an investor who's like, oh my goodness, I'm going to have these exponential returns. The other thing is that a lot of times a startup is making this kind of promise that they're like disrupting the market, revolutionizing the industry. So Airbnb is a really good example of a startup. And then more of a small business would be like if you opened a bed and breakfast and you wanted to rent out like 4 rooms in it. Airbnb started as an idea, but they basically revolutionized how the hotel industry operates. And they basically had a small investment and then was able to like basically go and say, okay, we're now worth, valued at billions of dollars. And the reason why they kind of have different investors is because if I'm a startup investor, I'm going to give you money, but I'm going to mostly think that most ideas are going to fail. And the reality is that if I'm giving you money and most of my startup investments are going to fail, as I'm building my own portfolio of how many startup investments I do, I need one of my businesses that I invest in to actually turn into Airbnb. Because for every Airbnb, there's probably like 9 businesses that are like, we don't even know their names, right? So a lot of times you have to have, in order to attract that kind of what would be called like venture capital or angel investors, you have to think about it. They're expecting this exponential growth, hyper growth, because they need that promise that like one of their businesses will return most of their portfolio plus that. Whereas maybe a small business investor is like, well, no, I'm going to like really, diversify in these small businesses. They're part of the community. I see them having a path to profitability, but it's going to be a slow and steady, sustainable way that they grow. And I don't need them to like return me like 100x on my investment, because I'm going to get, 5% here, 10% here, all there. And I'm going to have a healthy portfolio based on that. And thinking about investors, obviously if you kind of your business, identifies more as a startup, you're probably only going to see certain investors. If it's a small business, it's a different subset of, investors, at least in terms of what they're looking for from you. But you want to think about like, what does that investor bring for you? Because a lot of times startup investors, like why their money is good money is not necessarily just because it's cash, but it's because they have networks. They could help you get into a certain market. If I'm selling like, some kind of, quesadilla that I think is going to become a consumer packaged good. And if I have an investor that's like, well, I've gotten like all my other investments, like in every shelf and Trader Joe's in the country, I'm like, that sounds like good money, because I don't know anybody that's going to get my business on Trader Joe's. But if I took money from somebody and they like, I don't know, they like literally know nothing about food, I don't know, is that the same? Are those $10,000 worth the same? So think about like when you talk about investors, like what can they give you? And yeah, with equity, you have to be okay with giving up some control. Okay, so securities law. One thing is, just like as an attorney on the screen as well, like you don't want to be talking about publicly raising money from people unless you have an exemption. This is where crowdfunding and webinar 4 is going to be really helpful for you to think about what are some of the simpler ways to raise money publicly without having to do a lot of these filings. You want to think about it just the same way with debt. You want to think how much money you really want to raise and how much of your business are you willing to share. Those are things you want to think about the outcome. So it really helps you have your kind of negotiation tactics in and really what you're kind of driving home towards. defining your investment offering. Like, what exactly is the valuation that you believe that you can support? You always want to make sure that this is the numbers or something that you're talking about first. So it's not an investor looking at your paperwork and being like, well, I think you're worth $1. You want to come forward and first say, well, I'm worth $1,000, you know, and here is why. And I'll give you, you know, no voting rights, but I'll give you a little information on like how I'm doing once a quarter. You want to get that in the driver's seat. You know, it may come with some negotiation, but if you come as an open book and be like, oh, I want your money, I'll do whatever you want, like you may end up taking somebody's money and doing whatever they want. So it's always good to like know, what is it, you know, we always think like, you know, you guys are the business owners. You know, as long as you can stay in the driver's seat and controlling your business and its growth, you're working to do that. You know, like with anything, you want to prepare your business details. But with equity, it's really good to also focus on like that growth perspective. You know, with debt, like, you know, an investor might be really happy to just see that like every month your like average daily balance in your bank account is the same. That could just be like the best thing you ever see as a debt investor. But for an equity investor, they want to be like, well, they had like 100 customers in 2019. 2020, they had 500 in 2020. They're all, you know, that's what they want to know. Like, nobody wants to be like, okay, well, they're just like kind of here. An equity investor, again, because if you think about the reason why they're investing you is because they think there's going to be some kind of an appreciation in that value, or they're going to get some profits back. Finding investors that can add value. I think DC is just rich with accelerators and incubators. But also, you know, I think we live in you know, the pandemic has made a lot more accessibility in terms of like looking on LinkedIn and asking for introductions and finding people that may be available. And I think there's a lot more people that are open to like cold pitches, cold emails, especially if you have this laid out. You know, a solid presentation that does that and has a clear ask can still be good. So you want to just research all the people that may be. And then again, like you want to be able to demonstrate to this investor that like they're in it with you and there's this big, you know, goal that it's not so lofty, you know, pie in the sky, but it has, you know, you have traction to demonstrate you can get there. You're the right person to bring this idea, this business to its next level. And so that the investor can think, okay, well, if I give you this money, like I'm going to do good with this. They're going to do great with this.
And there are investors, like how do you find them? There are lists. You should be active and have a strong LinkedIn profile. Be on Twitter, Crunchbase, Pipeline Angels. There's lots of there are databases out there. If you don't know people, and many of us don't know heaps of investors out there, but also by having a presence, those two platforms is where I'd recommend, particularly LinkedIn.
So this area, hybrid financing, just stick with me on this one because it's a little bit confusing even for me for a while was. But if you think about it, one of the biggest difficulties with equity financing is the valuation. It is, especially if you're an early business, like how can you really both investor and business owner come to a true agreement about what that business is valued for? So with both the convertible notes and safes, the simple agreement for future equity, you're kind of just kicking that question down the road. And so in convertible debt, it's more so actually a debt. You say, okay, I'm going to get $1,000 from an investor. It's going to have like a 3% interest rate. It's going to mature at some point in the future. But you're also saying, okay, I'm taking this money from you as debt. But if in the future my business starts succeeding and I can raise more funding in what's called like a priced round, meaning like the business is just more mature and people all feel more comfortable about putting a price on what it's worth, then that, you know, money that you borrowed on the convertible note will kick in and turn into equity. But now why would a, you know, investor do that? And why would you want that? It's because the investor has some upside to it because they're giving you that money kind of risky earlier that may not have the same protections as debt because it's this kind of relatively, you know, different document. But you basically say, okay, investor, I'm going to give you a little bit of a discount on what the valuation I get from that future investor. So if my future investor says, you know, my business is worth $1 million, maybe you and I have come to this pre-agreement that you get a 20% like haircut off of that. And that business, you get it a little bit cheaper. So that same money converts to a larger percentage of our business. And so it really is just kind of like a way to still structure it as debt, but not that. The other side of it is like simple agreement for future equity, this SAFE. It's basically like doesn't really have a loan component to it. And it really only turns into future equity if you have that future pricing round in the future. So if that doesn't happen, it kind of just still sits as a SAFE on your books. But the same thing, like there's no interest that gets accrued to it. And with a convertible note, like you could agree that that interest would be additional equity that the person can purchase with that money that's accruing. But with the SAFE, you know, a lot of times people say that SAFEs are kind of the best ways for a founder, if they can, to be able to raise for those reasons. This is kind of like tying it all together. So debt we kind of started with, you know, this is something that I think people are the most familiar with. You know, even other types of debt that you might see is a personal or a business line of credit. You know, you don't have to give any ownership stake. You have the repayment rates. And then, you know, the big concern is, would you have some type of collateral? The hybrid that we just kind of discussed don't need to address the valuation. There's also, again, no collateral, but it helps you kind of be able to take in money from investor, but not have to worry about some of the major kind of paperwork and filings and kind of decision making at that stage. And then equity, again, you do give up that ownership, no collateral again, but that's when really you need to start having, you know, a lot of the conversations with hybrid and equity are kind of the same in terms of like what makes it attractive to an investor. It's still like that they want to see that there's the exit, the growth and all that. So I would say in terms of how you obtain them, what you need to be thinking about is a lot of the same things. So examples of equity, you know, the self-funding we talked about, that's your, you know, your internal investment. So many businesses start with, you know, first getting money from friends and family. My very first business, I accepted some money from family, you know, but then I was able to, you know, get loans and get other business partners as I got strong. So it's a privilege. But yeah, but that is a very common way people do get some. Selling some of their business, crowdfunding. We saw, you know, from Camille's slide, it's not a huge percentage of people that obtain that. I mean, most people do use self-funding, credit cards, all that stuff for it to start their businesses. But crowdfunding is still relatively new. And I think part of this pilot is to really see about making people, if it's a good fit for your business, to make it more accessible to you. Angel and venture. Again, those might be more accessible to a business that has that kind of hyper growth, you know, disruption of an industry type of a thing. Often the businesses that get the angel and venture also are kind of more in the tech kind of space. They probably don't have a lot of assets. And then the SAFE agreements, the simple agreement for future equity. Debts. Loans. So there's, you know, community banks, SBA loans are often, I had, my first loan was actually an SBA loan. It's a way to kind of de-risk yourself to a business because the federal government guarantees you often up to 90%. So a bank really only has 10% exposure often on investing in you. So it's not an easy money, but certainly it can be something that's more accessible. Lines of credit, you know, if you have your home, then you could get a home equity line of credit. Personal and businesses are also sometimes available. Something we, you know, I think 20 Degrees and I talk about a lot is, you know, line of credit is something, you know, even if you're a nonprofit, it's just a good thing to have access to in case of need. It's not something you want to go try to develop that relationship after the fact. Credit cards, both personal and business, and then convertible debt. So after all of this, if you're still with me, it's a big question. It's like, what funding is right for you? I mean, first you want to make sure that it is that you want money, that you need money. But then you have to ask yourself, like, okay, is it in my interest? Is it worth it to give up some ownership and control? And if so, like, what does that look like? Maybe it's I'm willing to give up some ownership and control because I want to minimize the risk to my own personal assets. I love this business, but that doesn't mean I want to put the house on the line. So maybe, trying to go after an equity investment could be the better route for you. Asking yourself, are you generating revenue? If you have revenue, you have a lot more avenues available for you. And if you don't, that doesn't mean that there's nothing is on the table, but it is less things. And maybe the right funding source for you is getting more revenue first. But maybe it's not a possibility because you really need that capital in order to, maybe your business is intensive or, people say bootstrapping all day as if it's some easy thing to do. I mean, sometimes you really do need that initial capital to make the business take off. Yeah, so I think the self-funding portion of it is just really to always think about, like, if it is possible for a path. I mean, I have seen some business owners that have used self-funding and they're really happy for it in the end because they don't have debt, they don't have equity, but it is something you have to look at. Every business model is different to think about that. And then, yeah, we just invite to you guys, what other questions, again, hop off chat, hop off the mic and tell us, but what other things are you thinking about as you're trying to be like, is this right for me? What are some next steps? We have a little bit of time left, so be happy to, and then certainly if the rest of the team wants to add anything.
Seem to have wowed them, Pooja. Didn't feel that way.
Or everyone's like,
it is, I think this is a lot to take in, and what we found when we've worked alongside others who are raising equity, there's a lot of different flavors of investors, but the more prepared you are up front, which can take a while between personal finances potentially, because don't think somehow that isn't nearby even for equity. They're vetting your idea, they're vetting you as the founder or leader, they're vetting the people you are turning to for advice. So a business that is ready to go after traditional equity. This is not crowdfunding necessarily, but there's a lot of similarities. We'll talk more about that next week. But it's a journey. And even if you decide at the end that you don't want to sign on the dotted line, if you tee up an investor, if it doesn't feel right, just going through and checking the boxes and understanding what it takes to look strong to an investor will help your business, whether or not you ever take a single dollar from anyone. So what they're looking for is what you should be looking for yourself. So that's why we also think that this is really just important for all business owners, because this is a way to surface just the essentials that are more likely to make your business succeed and grow.
I agree, and I think Pooja said earlier about the mindset. Like Sarah just said, it's a journey, and you might not be thinking about doing it now, but getting familiar with the terms, the process, and having the mindset, almost preparing to present yourself as an investor or raise worthy business. So when the time comes, you are able to pursue that. And I make a lot of trainings. I watch a lot of trainings. This is a training I would put, if I was a business owner, put in my bookmark to watch later. We'll be sending the link out tonight. But this has a lot of great information because at some point, as it was said earlier, you likely will go for traditional debt or maybe investment debt. But as you're trying to scale, there'll be a moment when you just don't have enough cash capital to cover your next move, and you'll be looking for some type of financing. And this has been an awesome distinction between the two and how they relate to the hybrid model. So thank you for that. I'm looking to see if we had any final questions in the chat. And if you're on phone, feel free to come off of mute, and I'll check my email in case anyone emailed inno.ed at
DC. I
dc.
saw one, how are equity investors able to enforce their equity control? That's a great question. And then please, if I'm not actually understanding it completely, but it is, the offering, is basically like a piece of paper. There's a lot of, crowdfunding has their own kind of agreements, but it is usually agreed in writing. The one thing about crowdfunding that we'll talk about in webinar 4 is that it's not really as much of a negotiation. You make your offering and you tell a investor, these are what they will get. And they say either yes or no. Your kind of, the work is done to make sure your offering is attractive. But with an investor like that meet kind of just in your private life, it could be a conversation. Certainly, I think that it's, the more money somebody gives you, the more ownership, the more likelihood that they'll also ask for equity. Sometimes you might say, oh, I want a board seat. It could look like that, where they have a right to vote that's very clear before you can make certain big decisions that are written in the documents. But you may find an investor that's like, listen, I believe in you. I'm not trying to get in your way. Just give me information. And, if you make certain, above this much in revenue, then, or not revenue, probably profits, then we want to make sure that you're eventually returning some to the investors.
We have a question in the chat, Pooja. How do you maneuver obtaining funding when you need to prove you have revenue, but in order to gain more revenue, you need funding?
Yeah, I mean, this is kind of like the founder startup dilemma. First, I think it's good to think about to that startup question, or not startup question, but one that we posed earlier, is thinking about what exactly all you would qualify for. So maybe what you're saying here is maybe you're not really going to qualify for debt. So you should start thinking about, what does equity look like, and even if you're eligible, is there any free money available? So there are some accelerators and incubators that don't take a percentage of equity and just have kind of rewards. There's pitch competitions, there's grants. There are, my very, very first business I started, I kept working full time while I was starting the business. So, not to say that was easy, but a lot of times people are using savings or money from a different job and putting it in that business. It's why I still like to do this work, because as much as I don't necessarily have the stamina to start another business right now, I love the hustle and the grit and the desire to make a difference from founders. But yes, it is very, very much kind of the dilemma. But then, you may think about I need to really position myself to make equity investors my friends. So now you start to have to think more in that mindset. Now you got to be thinking about, okay, well, I'm not making any revenue today, but you can say, this is what I did with 0 revenue. If I got $10,000, this is exactly how I would use the money. And let me show you how it would double my number of users. This is how it would make me get into this new market. You really need to make that connection between how that money helps to do that bit. Because the thing is true startup investors, true investors that believe in the equity mindset, they understand that capital is, money makes money. And the reality is that if you don't have any, it's not like, there's only so many hours you can hustle to sell something if literally all you have is your labor. So it's about, again, finding the right investors, but also making sure you have the business that tells a story that it is a good investment. Because all, debt, equity, everything we're talking about, you're taking a big risk by investing your time in your business, but an investor is also taking a risk by saying, okay, I'm going to give you some money to watch you do what you're going to do with it. And there's lots of other options out there for people, other businesses. How do you stand yourself apart? So hope that was helpful.
We've seen people start consulting businesses because those early dollars are hard. This is why oftentimes a lot of businesses are started by people who already have money to burn. That was not the case for us. So we had to find something that people wanted to buy. And then we did we had an extended timeline, and we didn't talk about all that stuff publicly about all the big things we were going to do, because for us, we knew we were going to start slower and to prove our revenue model within it. So we do see consulting businesses because the margins can be decent. Just to get you started, it's those first couple dollars, that first couple months, just something so that you can tell a story of strength, which is exactly what Pooja was saying so eloquently there about, how do you attract investors? Make it look like you don't need them, which is different than crowdfunding. But those are some differences. Well, again, we're teasing for next week here.
Mentioning next week, I think that's probably a good segue. Don't forget, we'll be here next week, Monday, 3 p.m. We're talking crowdfunded investments via WeFunder. So bring your questions, and we're excited to be with y'all next week.
Oh, you popped off the screen with the contact information, but a big thanks to 20 Degrees and the Marigold Effect. Again, this was a dense topic, but an important topic. It's worth rewatching again to get comfortable and have as a reference for when you're ready. And I'm going to switch over really quick to share my screen for a couple of other points about next week, which will be our fourth and final webinar in our information series on this pilot. But it won't be the last time we're talking about this topic. Again, this is a pilot project with 20 Degrees that we're just trying to see where people are at and what you might need. So it's helpful to get feedback so that we can be further help to you down the road. So that's the information. If you haven't already, please register for the webinar. And a little bit about coaching. So we've talked about the free guidance through the webinars, which is open to everyone. And then for DC-based businesses who are eligible with a priority for women and BIPOC-owned founders, we're offering coaching through the pilot through 20 Degrees. This is a coaching session to help you see if you're ready to raise through WeFunder or a crowdfunding platform. There are limited spaces available, so we are having an application process. There's no paperwork involved, but we want to ask questions about you as an owner, your business, your current financial situation, and what you're looking to, your past experience with financing, whatever it might be, and what you're looking to do perhaps with investment or crowdfunded investment financing. Again, it's for all stages of businesses, all industries. It does have to be a DC-based business, and if we have more interest than we have slots, we will be prioritizing women and BIPOC founders because that was the focus of this particular pilot. We'll open up the application on Monday. We'll send out a link to anyone who registered for the webinar series that's in the DC. And then we'll close it the following Tuesday at 2 p.m. We'll acknowledge that we received your application, and then we'll take a look to see if you qualify. And then if we have, again, more people than we have spots, we'll start to probably prioritize based on who the owner is and where you're at in the process. So we hope that you'll consider pursuing the coaching if it's of interest and you're eligible. And we'll wrap here today. Again, thanks again to 20 Degrees, to Marigold Effect. I'm looking forward to having you guys joining us next Monday at 3 p.m. And we'll be sending out the slides and the link to this presentation, as well as the capital readiness checklist that 20 Degrees made. We'll be sending it out later on today. Thanks for joining DSLBD and 20 Degrees and Marigold Effect. Have a great afternoon. Bye, everybody.